So welcome into another webinar. It is another Tuesday here in Singapore, but I guess Monday for you guys. We're prepping on President's Day because, this market's cut short a little bit this week. We only have a 4-day trading week. So welcome back to the Everyday Growth Advisors weekly webinar. Here with the team, the EGA tribe, attending the weekly webinar here as we prepare you guys for another week in this markets. Just a little bit of an update since I do live in the future in Singapore, so I get to see a little bit of a price action of what's going on before the markets open here. We had a pretty strong opening rally and a push up to all-time highs from this level right here. The S&P 500 now at 3,959. 4,000 seems to be the psychological level that we will probably hit in the shorter term. We are officially in some sort of a exuberant phase. However, not full exuberance yet. I may add that we had a pullback, and then hence this is another wave, impulsive wave to the top. This could go higher and could continue to press higher as we have a melt up situation here. Nevertheless, we have been positioning ourselves for these kinds of situations, and we do have active hedges against the market in case of a big drop. Now, remember, we take the stairs up, put the elevator down. So remain hedged, and I highly recommend to remain hedged. I will be remaining hedged until February is over. It is only somewhere in the last week of February, maybe next week or the week after, which is somehow the first week of March, where I will decide what I want to do with my hedge. Remember that I intend most of the time to take a 50 to 60% loss on my hedges before I roll them over into the next period. So I may decide to cut some of my hedges, which are in a 30% loss, 40% loss, and then roll those over into the next period so I can get myself more time value, more, better deals on those positions that I'm holding currently. Okay, so that's kind of the climate that I'm operating within right now, or what I'm looking at right now. So let's look at a few key statistics. Now, in no way is this webinar meant to tell you that you should be shorting the market outright. Okay, this webinar is just to create some awareness on what valuations look like, and you can make those decisions for yourself, of course. What's important here is, as a trader, you need to recognize when is the right time to buy, and when is the right time to keep adding, and when is the right time you shouldn't keep adding. And this is obviously one of those times in the market when you should not be adding any positions. Okay, so even though you shouldn't be shorting outright, you should not be adding aggressively, is what I'm saying. Okay, this is the point where you don't add aggressively. Yes, the market can continue to melt up. Yes, that can happen. But remember that after every impulsive wave, we have a corrective wave. And so you'd never want to buy when we're pushing up. You want to buy when we are on a dip. The time was here, but it still wasn't a very good signal. Even at this point right here, it wasn't a very good signal because we didn't actually come down to any significant Fibonacci levels, any significant support levels. We didn't really even touch the 50 moving average, which we have been doing in the past, kind of, doing that in the past to kind of test the 150 moving average or the 200. Therefore, this market continues to be on the uptrend. And so never trade against a trend. You just simply take hedges. Okay, so that's the market climate. But what is causing all of this? What is systemically, what is the issue here? Okay, well, the first thing you need to understand is that margin depths are at all-time high. Okay, margin depths are at all-time high. So if you look at this image right here, which I've very convenient downloaded for you guys, so this was part of our bots that signal this as well on our tweet flow. You can see that we're in an all-time high situation with margin depth. A lot of people are borrowing money to invest in the stock market, and this is not necessarily like a crazy thing that, oh, we are in a bubble phase where we can just pop. Remember, bubbles can keep growing bigger and bigger and bigger. Eventually, once valuations are stretched to such an insurmountable level, that's when the bubble pops, right? But in this case over here, I guess the theme of this week is balloons only get bigger, right? The more you blow into a balloon, the bigger we get, right? And that's what you need to understand. The markets will keep chugging along for as long as they can, because the markets can remain irrational longer than we can remain solvent. Okay, and so the main key theme here you need to understand is a lot of people are borrowing money to invest in the stock market, and this also at the same time, the reason why they're borrowing money is because we have a very dovish Fed. We've been talking about this for a long time. We have Powell saying, we're going to keep interest rates low. Don't worry, guys. Money will be accessible to you guys at a very cheap rate for a foreseeable future. Okay. And this is the key point. This is the key point that I want to make. The Fed being dovish now doesn't mean that the Fed will be dovish forever, right? Not forever. Okay. So the Fed could change their stance. Now, remember to watch out for that moment, because as quickly as this market can price in a dovish Fed, which is this rally that you see, right? And where inflation is acceptable and where everything is good. Remember what I said on last week's webinar, where we have real yields that are negative now, okay? Bond yields are now negative, okay? And so what is happening? The nominal interest rate's coming down. And so what happens in that scenario? Traders are starting to look at getting hedged, okay? They're starting to look at getting hedged. Now, the reason why the market will continue to run up is because a lot of people are taking puts. A lot of people are taking puts up here. Institutions are taking puts. Retail traders are not that dumb, right? They are thinking, oh, well, this market's already going up so much. Let me take some puts, right? The average retail trader now is more well-read than most people. And so they know that they should be taking hedges. And so the more people that take hedges, this will continue to melt up. This is the reason why I will be avoiding to take additional hedges at this point, but rather wait for the market to reverse and then add to my hedge position at this point, because hedges will be more expensive now until we turn around. So there is a point where we see, puts start to get more expensive, more expensive, more expensive. And then as the market keeps getting higher, what happens? People start to close out those puts because people don't understand the basis of a hedge. People think that hedges are something that are meant to generate returns. And so they hold those hedges hoping that, it pays them. But then the market keeps chugging higher and higher and higher. And this is something that's been happening this past week, which I only realized after the week was over. Sometimes you don't realize things while you're in it, but rather after you're done with it. And you realize, oh crap, you didn't realize something, that actually the open interest on SPY and the open interest on VIX have been severely skewed. And you can, and I speak about this on the Everyday Growth Advisors mentorship course, and I do a little bit of explanation about this, that you need to understand that the default position of SPY is to be hedged to the downside. SPY will always have a skew towards puts, always. It's always the case. Why? Because institutionals are the biggest holders of SPY. But look at the VIX over here. The VIX has been in a extremely big squeeze for puts, okay? If you can look at the open interest, and you can pull this up obviously now again for a fresh one, but this is the one from Friday, and it'll probably be the same since market was closed for so long. You can see that we have had a bigger open interest on puts than calls for this coming week and beyond, right? And then this coming next week, we don't have that much open interest on VIX, but it again comes back in March, right, where the open interest is skewed towards puts, but this is a pretty balanced kind of a scenario here. So the market tends to squeeze where the option players are. That's something you have to realize, right? Who is the holder and the true power of true holder and wielder of power? It's the person who holds the equities, not the person who holds the options. And so the people who hold the options usually get squeezed the most, and that's the reality of the situation. Okay, so something that I overlooked last week was the fact that SPY and VIX positions were slightly overwhelming. All right. Okay, so margin depth's on the rise, right? And then you have another thing that's that contributes to what I'm just explaining right here is the VIX futures, right? And you can see last week we had in the last 3 weeks we have had $2.2 billion of new shorts in VIX futures, okay, which was about 80,000 contracts, which means people were short the VIX and they were expecting for volatility to die down, which actually paid out big time, right? But then what happens is, while these flows don't necessarily mean that there's a spike in volatility, as these flows start to increase, that means that there will be a risk for volatility squeezes, okay? And so this is the reason why you want to remain hedged. This is the way of, the market shaking out weak hands, so you will, okay? Usually, it's pretty common that what happens is you see a big wave down, a big wave up, and then another big wave down, okay? It's what we call a shakeout, all right? It's a shakeout, but it's shakeout to the upside to screw over exuberant bears in this case, okay? So bears that were not having diamond hands, they will probably get juked, okay? And that's just the severity of the market conditions. Now, another thing to look at here is the Buffett indicator, something that, is also something you should be taking into account. Um, the Buffett indicator looks at the valuations of uh, uh, historical prices versus uh, the GDP of the entire market. Okay. So you can see that back in 2001 internet bubble, dot-com bubble, we were up at this +2 standard deviation level, which was strongly overvalued. And then bottom of the financial crisis, this was 2008. We were at almost negative standard deviation, -2 standard deviation. That was undervaluation, and now we're at the whopping more than +2 standard deviation. Now, this obviously means that in terms of market cap, we're starting to get overvalued here, right? This is just in terms of the Buffett indicator. So I'm just bringing this to your attention that we are at a period of extreme exuberance more than overvaluation. Valuations may be supported by the fact that we have a reopening on the rise. We have a lot of things on the horizon, COVID vaccinations that are possibly coming up. And so these are all things that will continue to drive and support the market into the next year, okay, as this economy starts to reopen back up. This is just my view, of course, not necessarily something that you have to follow. Of course, we have the Goldman Sachs sentiment indicator now signaling that we are approaching stretched positioning. So majority of investors, this doesn't say anything about bullish or bearish. We're just talking about stretched positioning, okay? How much are people stretching? And so this is, in terms of the stretch indicator, we're approaching more than one soon, which is 0.9 now. So signaling we're approaching that little bit of a stretch level. You can think of this as like your exuberance scale, right? So we're not like up here, but we are getting there. Okay, we're getting there soon. So as I said, we can run up a little higher, but it's good to remain hedged because you can never time a top and you can never time a bottom. So the best way is remain hedged and stay as vigilant as possible. Okay, and then this past week we had CPI numbers, right? Consumer Price Index, which is your core inflation. Okay, so you can see that the year-over-year core inflation here remains slightly muted, which means that we're not actually inflating. I think majority of the inflation increase was driven by higher gas prices. So gas prices were on the rise. Higher gas prices, not entirely because of higher oil prices. Remember, those two are not entirely correlated. This is a very majority mis-speculation that people do. Higher oil prices don't naturally translate into higher gas prices because you remember one thing, that the oil producers, they produce more than just petroleum, which is gas. Okay, I explained this in the previous time that we had a live trading session, that there are multiple products from crude oil. Okay, and those products get fractionally distillated, and in that fractional distillation process, you get one of them is gas. And so higher prices in crude oil doesn't necessarily translate to higher prices in gas. The only way that gas prices increase is when demand increases for gas, okay, and if supply stays the same. And remember that majority of resellers for petroleum products, they are usually gas station owners that have a relatively slight, they have a smaller margin, okay, they have smaller margin on these products. In fact, people who own gas stations, you might think like, oh man, these guys have been making lots of money. They actually have a very slim margin, to be honest. And so that's often something that's misunderstood in this market. So if you want to read more on the economic release report of the U.S. Bureau of Statistics, you can go read this. I already did the reading for you, so I'm trying to break it down for you in a way that it's much easier for you to understand. So you can see, although the indexes for electricity and natural gas declined, the energy index rose 3.5% over the month. Food index rose slightly in January, increasing 0.1%. That means the index for food just kind of like rose slightly. Okay, so not really crazy, but it's expected. We are consuming a lot more than we were, and food indexes rising slightly is more than fine. Okay. And then you can also look at all the other important facts and figures. If you go to bls.gov, this is the website. I never use any other websites. I use the official government websites so that the information is all factual. This is your latest numbers that you can look at over here. If you're looking for where I get all this information, where I do my research from, I literally use the government websites because that's what the most accurate source of information. They give you everything in charts, everything in figures, everything in numbers so that you can follow. Okay. So you can see inflation here starting off at 0.3, but remember, if the Fed keeps interest rates low, we'll see that continue to creep up. Okay. Okay, so the other thing about inflation that we need to talk about is the fact that, over time, what's going to happen is investors are going to start to price in. They're going to start to price in inflation. Okay, and so now that we are, in this exuberant level, and bonds are been continuing to sell off here. We are approaching that level of support here, which was the old resistance. Bonds can obviously continue to get cheaper here for a long, long time if this situation continues, right? And if bond gets cheaper, this kind of lessens the burden on a variety of different things, but risk remains on. So, however, last week I did see a little bit of institutional money coming into bonds, TLT to be very specific, okay, 20, 30-year bonds, because the yield curve is now it's kind of like a upward sloping yield curve. And as these, conditions go through in the market where liquidity is abundant and cheap, we may have a slightly more flattened out yield curve, or, maybe a even declining slope yield curve in the future. And that may pose a challenge for long-term bonds if short-term bonds start to have a higher return, okay, which means the market's expecting a higher return on risk-free assets in the shorter term than the longer term. That becomes the inverted bond yield curve, which we saw during the COVID crisis, okay? Obviously, I don't expect that to happen anytime soon. What I am saying, though, is that the market may, at any given time between now and the next quarter or the quarter after, start to price in higher interest rates for the Fed funds rate, okay, which is the target rate, right? So be on the lookout for signals of that. That's going to be something that we will have to keep our heads above the water for and really, really look at closely, okay? Cool. Now, so I fully expect in thesis that this market continues to chug higher until, a psychological level is achieved. I think, in fact, people are really just gunning for the $4,000 level. That's what this really, truly is about. Everybody's like, buy. There is that buying mentality. You remember that these things last for months sometimes, okay? The crypto mania has just begun, okay? And speculative investments are now starting to creep out, right? Remember, I keep telling you guys, when your barber comes to you and starts telling you that you should buy investments, that's when you should run for the hills. So this is not the time to be overweight on, specific sectors like tech. You don't want to be overweight on tech right now, okay? Because cheap can get cheaper, expensive can get more expensive, but here are the key things to know. So let's look at some of the technical analysis now. Okay, we look at this is how we always do things, right? We look at the market backdrop, the macro approach. We look at how things are going in the background. What is driving the structure of the market? How are the fundamentals looking like? What's the macro approach? And then now we dive into the technicals to see where are the things that we would like things priced at, right? This is how I do my analysis. This is the 60-40 approach which I use. You use that 60% of a macro approach, and then you use your 40% to line it up. You line up your things with your analysis, and obviously you can see how that will line up. So looking at this over here, this is the S&P 500 chugging along here. We had a slight downtrend here, and then we kind of reversed out, broke out, reversed into an uptrend, came back into our channel here, and we have been going on an uptrend ever since. We could possibly peak up a little bit here, a little bit of exuberance. We have done this in the past, okay, peaking out a little bit, peaking out. This is very common. So never get faked out like, oh, we're gonna just go to the moon now, right? But remember, 4,000 is a very, very possible achievement here, right? Very possible. We're not very far off. So even a run up to 4,000 before a reversion back to the moving averages would be a very possible thing. Now, I took off the moving averages here because I don't want to confuse you guys, because I want to show you what the levels are that I'm looking at before the moving averages are there. And then I'll lay the moving averages on after, okay? So The first level of support that I'm looking for S&P 500 to come back down to would be this level at 3880 or so. Okay, this is your support one. This would be the first level of support here for the market to kind of find some ground before moving to the upside again. Uh, and then below that would be this level right here, which is your old dual zone. Okay, this level right here, you can see that old dual zone right here. And this would be your 3850 level roughly, right? So this is your main market levels that you need to keep watch of. Breaks below these or above these, and can't remember that the candlesticks have to close below them or above them in order for these trends to be valid. Okay. And then of course we have the last line of defense, which is a very strong level of support right here. You can see this very strong level of support on the market here. This is the 3800 level. Okay, so 3800 is going to be a very strong level for the market support. And so if you layer this on into the moving averages, you will see from a technical standpoint, these actually line up perfectly with our moving averages somewhat, right? If you think about if this market corrects downward, this 50 moving will probably come down the slope somewhere here, coming down to the 23.6, which is exactly what we're talking about, right? From a technical standpoint. And then if you look at the 38.2, this is exactly where the 150 moving average is, right? So it kind of lines up perfectly with the 38.2 Fibonacci retracement as well, right? So we have two of those right there. And then the last line of defense, I like to think is always between the 50 and the 61.8. And that will be at slightly below the 200 moving average, right? If this were to kind of be the last line of defense, this is where we would see the market come down to support asset prices. Okay. So should you buy over here? Should you buy anything at all? I highly don't recommend it. Okay. I don't recommend it. Why would you want to buy things that are overpriced? I wouldn't like it. I would say stay out of the market, be patient, wait for the opportunity, wait for the pullback, and then pick up things at a cheaper price. Okay. And that's how we do things here at the EGA Tribe. Don't chase this rally. It might even run up to 4,000. Let people run it up, even 4,040, even 4,000, whatever. Let the market run its course. And then on the pullback is when you buy in, okay? Because when everybody starts to buy these and the market pulls back, then the cascade of waves of selling will cause asset prices to depress even more, okay? And so wait for that over exuberance to kick in before you start jumping into these things, all right? Perfect. Now, what are some things that I'm looking at to invest in right now? Here are my top things that I'm looking at. The first thing that I want to look at is gold. All right. Gold has been in a consolidated phase for a while. We spoke about how this was sitting on a support level and has come back into the demand zone here. If it falls below again, back to this 168, 178 level, I want to buy some calls to the upside up to the $180 level, somewhere here where the resistance is. I may even pick up maybe some 174 calls and just take them for a month out and hold this as a hedge against inflation, against a bunch of different things, risk assets, and just overall market hedge. This looks like a great play, in my opinion. Gold has a lot of versatile uses, and this is something with a huge market cap that you can't really, you can't really manipulate that easily, which is what makes it attractive for me. Now, as we see inflation continue higher, what does this mean? This means that bond prices will continue to stabilize. Okay. Now, you have to remember one thing, that when bond prices continue to steepen, or the curve continues to steepen, as I said, we're in an upward sloping curve now, which means that bond prices are adhering to the traditional market structure, right? Then what happens is that long duration bonds will be a challenge to support, right? Because the shorter duration bonds will have a certain return, and then the longer duration bonds will have a slightly higher return in these environments, right? So this steepening of the yield curve is usually a challenge for long duration bonds, okay? But this usually is a support to two things. Well, actually more than two things. But the main sectors that benefit from this kind of a situation are financials, okay, cyclicals, which are your tech stocks, blah, 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 right? Your chip stocks, blah, 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 right? That's your cyclicals. Even travel stocks are cyclicals, right? And then also you have industrials, materials, and energy. Okay, these are the key sectors to look at right now. All right, and so I'll be looking at opportunities in those markets, and then looking at the top performing, you know, uh, assets in those classes to take my best picks during this next remaining 2 weeks of this month. Okay, as I expect the market to start pricing in this things. Now let's have a look at the financial chart, right, real quick. About 5 minutes more on this webinar so that I'm going to wrap things up pretty quickly here. Okay, so what I'm looking at, first things first, XLF, the financial sector select ETF, right? Nice little uptrend recovery back here. You know, expect this one to push up and break out of this over here. Volume has been dying down, but then it recently came back up, and we'll see if we can get a push up to the 33 levels here. This may be a good long-term hold. If you wanted to take, you know, leaps on XLF, it would make sense, but wait for a slight pullback and then get in. Bonds, I already explained this. I saw some institutional flow back in here. I think it's a good time to maybe average down a little bit on our position, but not too crazy. I will decide if I want to do this. If not, I may just decide to hold the bonds that I existingly have. And then Russell 2000, this is looking way overbought right now. On a daily chart, you know, this is a very strong uptrend, but needs a pullback to the moving averages, okay, which it does from time to time. So it could continue to run up here, but I think a pullback is in order. Now, the true investment that I actually do like right now, comparatively to everything that we're thinking of trading, we should take a step back and look at emerging markets for a second, right? And JPEM, this is one I've been telling you guys about. I've been looking at this one for a while. It's a diversified emerging markets ETF. And I specifically like this one for the diversification of all asset classes, and then within different sectors and different economies, Russia, China, India, Indonesia. There's a bunch of different countries that are a part of this fund, and I really like the diversification of this fund. Also looks like a great play for when the economy opens back up. Okay, things that are overvalued right now. Chinese tech are approaching pretty sickly overvalued levels. I think puts on KWeb here may pay if you take some puts. Okay, I think you know, taking some $95 puts or even some you know, $90 puts might end up paying on KWeb if we can play this nicely once we see a confirmation of a downtrend. I see the consolidation up here. It may continue to run up, but then I think that taking some puts on here may be a good, nice little blaster if we are looking at an exuberant market. Okay. And then also the VIX is now sitting once again at a very key support level. Okay. Very key support level here at the $20 level. And I spoke about this at length last week, and I'm speaking about it again today, that, you know, this level has been a very key level to pick up the VIX. And picking up and holding the VIX here makes complete sense. I wouldn't say that, you know, okay, it can go lower, but remember that I think that holding these hedges are a very fair play because the VIX moves very quickly when volatility spikes. Okay, so buy things when they're cheaper instead of chasing for the VIX when things get expensive. You can buy and hold this for a month out, for a month and a half out, and then bank when the time comes. Okay, so there's a lot of good plays that I've mentioned in the playbook for this webinar this week. If you're listening in from the YouTube channel, you're listening in from Instagram, you're listening in from wherever you're listening in from, this is what we do on a weekly basis on the Discord. And then based on what we say and what we talk about on here, it goes into a weekly report for you to read. And then on top of that, we trade these ideas on a weekly basis so that you can be well informed and trade these throughout the week with us on the Discord community. You know, we hope that you will be a part of our community. The EGA tribe is growing on a weekly basis. And I hope that you sincerely like this webinar. If you did, you made it this far, you listened to the whole thing, drop a like, drop a comment. I love hearing back from you guys. And yeah, that's all I have for this week. We will see you next week, a perfect 30-minute webinar to just give you a crash course on what's going on in these markets. And good luck on this trading week. And it's a shorter week, so be careful. Don't take oversized positions. Do not be going extremely long here. And I will see you guys next week. Peace out, guys. Love you all.